Let's be honest. We all feel that sense of dread when we think about April 15th, right? But what if I told you the biggest, most costly tax mistakes have nothing to do with April? They're actually happening right now. You see, by the time we get to tax season, the game is pretty much over. The real action, the real opportunity, is in December.
So here's our game plan. First, we're going to shatter the April tax illusion. Then we'll focus on why December 31st is the real deadline you should care about. From there, we'll jump into some powerful, practical moves you can make before the year is out. I'll even give you a quick 30-minute checklist. And the whole point of this? To switch from that feeling of panic to a feeling of power and plan.
All right, let's dive right in with this idea of the April tax illusion. We are all trained to think of taxes as a springtime chore. But that mad dash to find receipts and fill out forms, that's not you playing the game. That's just you reporting the final score. The game itself was won or lost months ago.
So I want you to really think about this question. When is your tax outcome for the year truly set in stone? Is it April 15th when you file, or is it midnight on December 31st? Getting the answer to this right is, well, it changes everything. And this right here is the absolute heart of the matter. The biggest tax mistakes are almost never a typo or a math error on your return. Nope, they are the missed opportunities from the year that just ended. Think of it like this. All year there are these doors open for tax savings, and at midnight on New Year's Eve, they don't just close, they slam shut and lock for good.
This brings us to the single most important mental shift you can make. We need to stop thinking about tax preparation and start thinking about tax planning. I know, they sound super similar, but believe me, they are two completely different things. One is looking backward, and the other is looking forward.
And here you can see it laid out side by side. Tax prep? That's what happens in April. It's totally reactive. It's basically history class. You're just reporting what already happened. But tax planning, that happens before December 31st. That's proactive. It's about making strategic decisions now to change your financial story for the better.
Here's a good way to think about it. Tax preparation is like being a sportscaster, just reading the final score of the game. Tax planning is being the coach on the sidelines, calling the plays while the clock is still ticking. And for your tax year, that clock hits zero on December 31st.
Okay, theory is great, but what are these actual game-winning players? Let's get really practical here. We're going to walk through some of the most effective moves you can make before year-end, broken down by who you are.
So first up, let's talk to all the employees out there. If you get a regular W-2 paycheck, you have at least two huge opportunities hiding right in your benefits package that a lot of people they just miss them.
Number one is your 401k. Every single pre-tax dollar you put in there lowers your taxable income for the year. But here is the critical part. Those contributions have to be made through your payroll by December 31st. You can't just write a check in January and have it count for last year. The window closes. And the second one is your FSA.
The flexible spending account. It's awesome. You use pre-tax money for medical stuff, but it has that notorious use it or lose it rule. If you have money left in that account when the clock strikes midnight on your plan's end date, poof, it can be gone forever. That makes it December check-in totally non-negotiable.
Okay, let's switch gears and talk to the investors. If you have a brokerage account, December provides this really brilliant way to take some of your losing investments and actually turn them into a powerful tax-saving tool. The strategy is called tax loss harvesting. And I know, it sounds a little weird, right? You're intentionally selling something that's lost money. But why would you do that? It's because the IRS lets you take that paper loss and use it to cancel out the taxes you'd owe on the gains from your winning investments. It's a fantastic move.
And the process is actually pretty straightforward. Step 1, sell an investment that's down. Step 2, use that loss to offset the gains on an investment that's up. And step 3, this is the key. You immediately reinvest that cash into something similar, but not identical, to stay on the market. You just have to watch out for the wash sale rule, which basically says you can't sell and then immediately rebuy the exact same thing just to create a fake loss. And of course, this all has to be done by December 31st.
All right, next up for anyone who likes to give to charity. A few years back, the tax law changed, and the standard deduction got a lot bigger, which is good, but it also made it harder for a lot of us to actually get a tax benefit for our charitable giving. But there's a smart year-end strategy for that. It's called charitable bunching. The idea is, instead of giving, say, $5,000 every year, you bunch 2 or 3 years' worth of giving into a single year.
You'd give $10,000 or $15,000 all at once. The whole point is to push your donations high enough in one year to get over that standard deduction hurdle. That lets you itemize and get a real tax break. Then, in the other years, you just take the easy standard deduction. It's the same amount of giving, just structured way more intelligently.
And finally, for all the entrepreneurs and small business owners out there, for you, December is without a doubt one of the most important months of the entire year, and it's all because of one powerful rule in the tax code.
We're talking about the Section 179 deduction. For a business, this thing is a total game changer. It lets you deduct the full purchase price of business equipment, a new van, new computers, new machinery, in the same year you buy it. The only rule, the equipment has to be placed in service, which just means you have to be actively using it by, you guessed it, December 31st.
And just look at the potential scale here. For 2025, a business could write off up to $2.5 million in purchases. This isn't a small deduction you spread out over years. It's an immediate, massive write-off that can slash your business's taxable income. But if you wait until January 2nd to buy that equipment, you have to wait a whole other year to get that deduction. Timing is everything.
Okay, I know that was a ton of information. You might be thinking, this sounds great, but it also sounds like a lot of work. Well, here's the good news. You don't need to block out a whole weekend for this. All you really need is about 30 minutes.
No, I'm totally serious. One focused 30-minute financial check-in sometime in early December can literally save you thousands of dollars come April. This is not about becoming a CPA overnight. It's just about asking a few simple questions before all those doors lock for the year.
And here it is. This is your checklist. It's that easy. Just go down the list. Pull up your last pay stub. Are you on track with your 401k? Log into your benefits portal. What's your FSA balance? Open your brokerage app. Are any of your stocks in the red? It's just 5 questions, but the answers could dramatically change your tax bill.
You know, when you start doing this, it fundamentally changes how you think about taxes. It moves you out of that cycle of April anxiety and into a place of cool, calm, strategic control.
If you take one thing away from our time together today, let it be this. Our tax system is designed to reward planning. It is not designed to reward last-minute panic. The opportunities are sitting right there for you, but they are tied directly to the calendar. And that calendar always turns on December 31st.
So I'll leave you with this final question. Based on everything we just talked about, what is just one, simple move you can make before the end of this year to improve your financial picture? Maybe it's just bumping up your 401k contribution for your last 2 paychecks. Maybe it's finally buying those new glasses with your FSA money. Taking that one small, proactive step is how you begin to turn taxes from an annual problem into a year-end opportunity.